Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Shut up and take my money.
That is an all-time low.
And the old bear is back.
I'd buy that for $1.
Telling me, dream.
Hello and welcome to another edition of Buy or Sell. I'm your host, Adam Keily, host of Comedian vs. Economist podcast and widely regarded as one of the simplest minds in finance. Luckily for us, I'm joined by an expert to educate me and hopefully you on how they're thinking about stocks and the stocks they're thinking about. This isn't a deep dive though. We're going to get through as many stocks as we can in the time that we've got. And you can of course find out more about each stock on the Equity Mates website. Let's get to it. Today, I am pleased to be joined by Will Mumford, Deputy Portfolio Manager at Auscap Asset Management. Welcome to the show, Will.
Hi, Adam. It's great to be here.
Absolute pleasure to have you on. Now, Will, let's begin with a song just to set the tone for our investing journey this afternoon. What's your go-to theme song, Will, if you had to have one?
Well, I'm going to go with a late 90s R&B classic, which is No Scrubs by TLC.
Oh, banger. Absolute banger. Right.
So for those who aren't familiar with the song, it's about having high standards for a partner, particularly from the perspective of avoiding those who don't make enough money. Now, I definitely don't think this is what you should do when you're dating. Money shouldn't have anything to do with that. But when you're investing, you're here to make a return. So I think it applies. So I believe you've got to have a really high bar for investments in terms of quality, cash generation, earnings growth management, balance sheet, valuation. And if a business isn't meeting those standards, or just as importantly, stops meeting those standards, you've got to be ruthless. No scrubs.
No scrubs. I like it. Just ahead of Gold Digger, perhaps. Very good. All right, let's crack on. We've got some stocks to get through here, some really interesting ones. So strap yourself in. We're going to kick it off with Reliance Worldwide Corporation, ASX RWC, currently trading at $4.18. Reliance Worldwide Corporation, the plumber to call when all the toilets are blocked. Just imagine being an apprentice there. Some international travel required. Buy or sell for RWC, Will?
Yeah, so it's a buy for us. So RWC, it's a business that it might not be known to everyone in the audience. It's a pretty boring business. It sells what's called behind-the-wall plumbing products, which are across both the US market and to a lesser extent Australia and Europe. And its best-known product is called the Shark Bite, which is what's called a push-to-connect fitting that allows two pipes to be connected easily and quickly. Now, in its key US market, about 60% of its sales serve the defensive repair market, and the balance of the business is exposed to the more cyclical but generally still growing new build and renovation markets.
Right. So we don't find these products at Bunnings. This is more targeted at your builders, developers, etc.
Yes, so they are at places like Bunnings, but yeah, it's targeted at the plumber. It would be used by a plumber, not as a DIY job. So RWC is one of just a handful of ASX companies which mainly sells to the US market, but it also sources some product from China. So it's been in the tariff crosshairs a little bit more recently, and it has sold off pretty dramatically on the tariff concerns and on the risk that a soft US housing market could lead to some short-term disruptions to the earnings of the business. And I think that's a real risk. And so you've got to have your eyes wide open about that risk here. But there are also a lot of mitigants to be aware of. So it's only about $120 million of stock that Reliance sources from China into the US market, which is about 16% of the group's stock. So it's not huge.
Yep.
As I said before, 60% of the sales are for essential plumbing repairs. And longer term, I think there's potential for RWC to take some mitigating action here. It can source from other countries. It can put price increases through. And RWC's competitors are in the same position or worse in terms of sourcing from China. So right now, RWC, it's trading on about 12.5 times PE. Its average PE has been at closer to 16 times over the last 5 years. And long term, I think its earnings should grow. albeit with a bit of cyclicality. So if you can look through this and the likely disruption in the next year or so, I think RWC is looking really attractive.
It's a buy.
I think I'm going to buy it.
All right, next up, we're going to take a look at HomeCo Daily Needs, REIT, ASX HDN, currently trading at $1.23. And if you like bricks and mortar, these guys are your man. Tell me about HomeCo Daily Needs.
Yeah, so HDN, it's a very simple story, which is what I love to see. So it owns a diversified portfolio, which sort of has two parts. One part is local neighbourhood centres, which might be anchored by a Coles or a Woolies, with maybe an Aldi, a pharmacist or a medical centre in the centre. And then the other part of the business is large format homemaker retail centres, which might have tenants like Bunnings, JB Hi-Fi or Nick Scali in those centres.
Right.
The key thing for HDN is all of its centres are very well located in high demand metro Aussie locations, but its rents are still very low. So its average portfolio rent is about 30% below the national average for retail centres on a per square metre basis. So if you're JB Hi-Fi or Rebel Sport, you're really happy for your rent to go up every year in the HDN centre because it's still a lot less than you're paying in the Westfield down the road. So if you're after dividend yield and yield, you don't need to push into private credit. In HDN, you can get a dividend yield of 7% today, and their rent's sustainably growing at about 3.5% per annum. And then on top of this, the business owns a lot of underutilized land that they're trying to develop over time, which should add to returns. The other thing to point out is that the REIT sector has been under pressure from interest costs more recently as we have had higher interest rates, but most REITs have now weathered this pain, and if we do get any cash rate cuts from here, they're positioned to benefit. The other point is that HDN has underperformed a lot of the other retail REITs, even though its operational performance has been really strong. So some of the other REITs are now offering dividend yields as low as 5%. So I think if you're after some yield and a defensive value proposition in a tough, confusing macro environment, I think this is a buy.
And people are still meeting their friends down at the mall? Is that like, we're not worried about the threat of online? People are still like attending these places in the same numbers they used to?
That's a good point. So I guess I think in the eye of that storm are the Westfield of the world, whereas these guys are sort of the daily needs, your Coles or Woolies shop.
Yeah, okay.
Interestingly, Coles the other day was saying that they still expect their online sales, about 96% of those to be fulfilled from their store network rather than centralized fulfillment. So if you're buying your Coles or Woolies shop online, most of those are going to come from the store. And the Coles or Woolies also really need these stores because if Coles wants to open a new store, it takes them 5 years for that to happen because of all of the approvals they have to get through. So they need to partner with people like HDN. And then on the other end, you've got the large format retail centres. And the key thing here is if you're buying a new sofa, a two or three grand sofa, people often want to sit on them. And so that sort of part of the market has had a bit of insulation from online. It's a bit different if it's the $200-300 sofa, the IKEA thing. But if you're spending a bit more money, people often want to sit on them.
Absolutely. I tried buying a second-hand sofa the other day, and after about the third person's house of testing out a couch, driving to 3 different places, I thought this is no way to buy a sofa. And online would be the same problem, right? Like you like there are some things you just absolutely have to sit on.
Exactly.
All right, very good. So HDN is a buy.
I think I'm going to buy it.
All right, next up, BHP Group Limited, ASX BHP, currently trading at $38.07. I was reading the locals are actually upset in Port Hedland because BHP are going to demolish the Pier Hotel, once described as the world's toughest pub. So yeah, a little fun fact. According to local legend, the pub once had 86 stabbings in one night. So
jeez.
That's a big night down at the pub.
Yeah, I'm not sure I'd laugh in that the world's toughest pub.
It's not for you and me, Will. Just putting that out there. So they're going to knock it down and build a park. Nobody ever got stabbed in a park, of course. But anyway, BHP, buy or sell?
Well, hopefully the locals will like that I've got a sell on BHP. So I think it's worth comparing where the Australian iron ore majors have been for the last 20 years with where we're sitting today. So over the last 20 years, the iron ore market has been a cosy oligopoly of a handful of Australian and Brazilian companies who have benefited from this enormous growth of China, which has grown to become more than half of the world's iron ore demand. And that's just been fantastic for shareholders. But today we've reached the point where Chinese iron ore demand has peaked and it's actually started declining. And there's little prospect of the rest of the world offsetting this decline. And we're also getting closer to new supply coming from the mega Simandou projects, which are high grade and have the potential to move iron ore prices lower for the entire market.
What's Simandou? Sorry, for those that might not be familiar, including myself. Simandou is that another company?
Yeah, they're up-and-coming large projects,
right,
which are high grade and large scale, and they've taken years to develop, and we're now getting to the point where they're going to be hitting the market at the same time as Chinese demand is potentially growing.
Okay.
And so the major miners don't really dispute these risks. So both BHP and Rio have recently pursued M&A into other commodities like copper. And the press has also rumoured that BHP was looking at entirely divesting its iron ore business. But it's really hard to replace the super profits and market structure of iron ore. And against this backdrop, most analysts are expecting maybe a 4.5% dividend yield from BHP and minimal prospects of this to grow over time. So I'm not saying everyone has to dump their BHP shares today, but I think Australians should be thinking about whether a 4.5% dividend yield is sufficient as a total return for a mining company, and whether they've got too much exposure to iron ore across their portfolios of, across BHP, Rio and Fortescue.
No, fair enough. If you bought the big Australian, maybe you're not going to be happy owning the medium Australian. I don't know. All right, staying with mining, Rio Tinto Limited, ASX RIO, currently trading at $116.47. Now, there's a bit of a storm brewing at Rio. 4 storms to be exact. They had no less than 4 cyclones, Will, in January and February that scuppered their iron ore exports for a little bit. Where are we at with Rio Tinto, buy or sell?
Yeah, for me, Rio is pretty similar to BHP. So it has a slightly different commodity mix. It's got some exposure to copper, aluminium, and more recently lithium. And it is a major investor in the Simandou projects. But analysts still attribute roughly half of the business's value to iron ore, which is really the crown jewel of the business. And it's got one of the best industry structures globally in mining. And the outlook, like I said before, is now very different to the last 20 years. So Rio's dividend yield is roughly 5%, but with uncertainty about the growth outlook, to me, this is also insufficient. So I've got it as a sell.
Got it as a sell. All right, awesome. We're going to finish off the break here with Commonwealth Bank, ASX, CBA, currently trading $165.59. What do we think of CBA, Will?
CBA, it's a great, high-quality, dominant bank, but I think this is the case where no scrubs applies, because it's just very difficult to see how the future return from here will meet my standards. So sell.
That's a sell.
Your return as a shareholder, it's always going to be driven by 3 things. It's the yield of the business, it's how much those earnings are going to grow over time, and it's the multiple that the market is going to pay for these earnings. Now, CBA's current dividend yield is about 3%. Its earnings growth over the last decade has been less than 1%, and analysts have this going to about 2% in the coming years, and there's probably downside risks to that number. And CBA's PE multiple, which is the multiple for these earnings, is currently 26 times, which is the highest it's ever been and well above its history. So you've got 3% plus 2% and then risks to the PE multiple, which to me, it just doesn't cut it. So I'm not saying if you've inherited CBA shares at a super low cost base, you've got to sell them tomorrow. But I think it's a stock that all Aussies should be thinking about whether they've got too much exposure to. So to me, on valuation grounds, it's a sell.
It's a sell. All right. A scrub is a bank that can get no love from Will. Very good. Let's take a break here. We'll be back with more buy or sell right after this.
And the old bear is back. I'd buy that for $1.
Welcome back. You're listening to Buy or Sell. My expert today is Will Mumford, Deputy Portfolio Manager at Auscap Asset Management. We are talking no scrubs, and we're going to start by looking at Scali Limited, ASX NCK, currently $17.70, recently expanded into the UK. Now specialising in settees and duvets, I hear, as well as couches. Will, buy or sell for Scali?
It's a buy. So
right.
Scali has been a long-term holding for us, and we think it's just a great business. It's got a long track record of earnings growth, and its return on equity is consistently amongst the highest on the ASX. And there are a few reasons why it's great. So it's a very capital-light business because most of its sales are made to order. So it doesn't have to hold inventory at the back of its store. Expanding the store network is really profitable, and the cost of a new store is often recouped in 1 or 2 years. And Nick Scali's cost base is competitively advantaged because of its scale. It gets some of the best buying terms from all of Asia's biggest factories. And this is only getting stronger in the current tariff environment as US furniture companies source from elsewhere, leaving excess capacity within China. The other point is that Nick Scali owns a lot of its stores, so it's somewhat insulated from rental inflation relative to peers. And whilst earnings can be a little bit cyclical, they've grown really strongly over time, from $7 million at IPO to $82 million last year. But as you mentioned, Adam, the big news has been the expansion into the UK market with the acquisition of Fab Furniture, which they paid next to nothing for. And their plan is to gradually replace all of the Fab products with their better Nick Scali products, and then refurb the 20 stores. And then once the stores are up to scratch, rebrand them to Nick Scali, and potentially then roll out future stores into that market.
Right.
And it's an exciting market for a few reasons. So firstly, it's a very large economy relative to Australia, and it's also very similar from a furniture perspective to Australia. They're also used to made-to-order furniture. The other thing is there's all of these obvious areas of financial self-help available to the business in the UK. So Fab's revenue per store is well below Nick Scali's revenue per store in Australia, and even further below the UK market leaders. There's also a big opportunity for Nick Scali to fix up the gross margin of Fab and get it closer to their margin that they're achieving in Australia. And finally, there are cost out opportunities. And then if this model gets right and is working, we then expect them to hit go on a store rollout. And because of the size of the UK market, 50 or 100 stores is very achievable, and that'd be big for group earnings. And so far the signs are really encouraging that the Nick Scali model is resonating in the UK, and we've been over there twice in the last year.
Right.
So Nick Scali's Australian products, which have been introduced into the Fab stores, are already amongst the top sellers. And the early Fab stores that have been rebranded to Nick Scali are already amongst the top stores within the Fab network. So Nick Scali is currently trading on a similar PE multiple to other high-quality ASX domestic retailers like JB Hi-Fi. But don't forget, the UK is currently losing money, which is distorting this multiple for Nick Scali. And if the UK rollout succeeds, history suggests that Nick Scali has the potential to trade at a premium multiple, because businesses with global growth tend to achieve a premium multiple on the ASX. So we remain really positive here.
Right. So Bunnings tried to expand into the UK and it didn't go so well. Are there lessons to be learned here for Nick Scali from the Bunnings efforts, or is this a completely different ballgame altogether?
Yeah, I mean, definitely. Like, there's always risks with international expansions, but I guess there are a few mitigants here in that it was done in a very low-risk way. They didn't pay a lot for this Fab business. Their costs are pretty much just the refurbs of these operations. Anthony Scali has been visiting the UK market for a long time. There is this similar made-to-order furniture model, and the early signs are that the product is resonating. So it's not done, and the UK economy has been through a tough period. This isn't a foregone conclusion that this is all going to work out, but if they were to deliver on this opportunity, it's huge.
Yeah. Awesome. All right. So Nick Scali is a buy.
I think I'm going to buy it.
Next, we're going to take a look at Car Group Limited, ASX CAR, currently trading at $33.06. Formerly carsales.com. I didn't realise they have marketplaces all over the world now. So if you're listening in South Korea, Chile, or the US, we've got you covered. This is all sorts of cars. Where are we at with Car Group? Will, buy or sell?
Yeah, so we think Car Group, which, as you said, is probably best known by its old name, carsales.com, is a buy. And it's been a really strong grower since it listed about 15 years ago. Its earnings per share are up about 8 times since then. And the big news is that, particularly since COVID, the business has become a much more international business. And this is due to the acquisition of Trader Interactive in the US, which is a leading non-auto US classified business, so things like RVs, and the 70% acquisition of Web Motors, which is the dominant used auto marketplace in Brazil, which is similar to car sales in Australia. Today, the majority of Car's revenue is sourced internationally, but because Car hasn't rolled out and monetized all the features that it has in Australia into these international markets, the margin for the international business is still a lot lower than Car is achieving in Australia. So it's 50% versus 65% in Australia. So as CAR rolls out all of its features and monetizes them in these international markets that are much larger than Australia, it should have a long track record, a long outlook for earnings growth. And that's what they've been delivering.
Right.
Now, in the last 6 months or so, the RV end market in the United States has been a bit soft, and that's weighed on the share price. But ultimately, this is a cyclical factor, and the US still has lots of secular growth factors for CAR Group. And so despite this great market position and earnings growth outlook, the CAR Group PE is below its closest ASX-listed peers and the IT index. So it's on about 30 times PE, and it's a dominant capital-light business with a proven global growth story. So I think it's a buy.
I think I'm going to buy it.
It's a buy. I love it too because I can't decide whether the future is going to be electric cars or whether we're all going to get sick of electric cars and go back to petrol. So to own a company that just sells whatever cars are popular, I think makes a lot of sense because I think we're always going to need them. So yeah, I like it.
That's an interesting question as well. Yeah.
All right, next up, we're looking at Seek Limited, ASX SEK, currently trading at $21.22. Listeners of Comedian versus Economist would know that job ads have been falling. If people are looking to buy cars, Will, they're probably not also looking for a job. Is that right? So are we selling Seek?
Yes, so I have Seek as a sell. So Seek, like you said, it's probably well known to the audience. It owns the Seek website in Australia, which generates most of the group's profits, but it's also got a presence across Asia and a venture capital fund. And whilst it's often compared to REA or CAR Group, the reality is that its financial profile has been very different. So earnings per share for Seek since 2012 are actually flat, whereas CAR and REA have at least tripled their earnings per share over this same period. Now, there's a debate over what's the cause here, but it's probably a combination of a fundamental difference in the criticality of a job marketplace relative to a used car or a real estate marketplace, more competition, the cyclicality of the job market, a lack of cost discipline, the Asian investments not working out, and a bit of distraction from this Seek growth fund. So the market's always expecting a turnaround for Seek, but so far it just hasn't delivered. And sitting here today, it's trading on 40 times PE relative to CAR on 30 times. And we're much more confident in the quality and earnings growth profile of CAR. So sell.
Seek is a sell. All right, we've got a couple to finish off with. First one is CSL Limited, ASX CSL. People generally love CSL. I love to talk about CSL anyway. $249.02. Buy or sell for you, Will, for CSL?
So CSL, like you said, it's a market heavyweight that we found too expensive to invest in for most of the fund's existence. But today we think it's a buy.
Okay.
So it has three key divisions. So its key crown jewel business is called Behring, which collects blood and then uses the plasma to treat underdiagnosed rare chronic diseases. Its second largest business is called Securus, which is mainly an influenza vaccine business. And its third business recently acquired is called Vifor, which is a kidney dialysis business. Now, CSL has been a market darling since it listed. It's tripled its earnings over the last decade, and it's traded above 40 times PE at times. But today it's down to 22 times, which is the lowest in a decade. And that's for a few reasons. So COVID and inflation have impacted the growth of Behring. It's disrupted the ability of CSL to collect the blood, as well as to collect it in a cost-effective way. The market also hasn't liked the Vifor acquisition, and Securus has been really volatile over the COVID vaccination period. A couple of CSL's updates haven't met the market's expectations, and more recently, sentiment has been negative due to the perceived Trump risk on the business, especially with RFK in charge of the health department. But today you've got CSL trading on 22 times. It's targeting double-digit earnings growth out to 2028. It's pursuing projects to expand its margins. It has a large US presence, which gives it a level of tariff insulation. And so there probably is some short-term risk around tariffs and Trump, but I'd like to think this is in the price, and I think CSL is a sensible portfolio addition. So buy.
I think I'm going to buy.
CSL is a buy. I actually donated plasma the other day. I don't think it went to CSL though. I think it went to the Red Cross. You should go and do it if, listening out there. It's a worthwhile thing. All right, Will, we got one final stock to get through. This is your big pick. Resmed, ASX RMD is the ticker. Currently trading at $36.73. It wouldn't surprise me if Trump did try and put a 10% tariff on bedtime. time. But Resmed seemed to dodge that bullet. Will, Resmed, a buy or a sell?
Yeah, so buy for Resmed.
Yep.
So Resmed's the clear market leader in CPAP devices, which treat obstructive sleep apnea, which is a serious health condition that's heavily underdiagnosed. In the most penetrated market, which is the US, Resmed thinks that only 20% of cases have been diagnosed. And Resmed thinks globally there's probably about 1 billion people with sleep apnea, and less than 3% of those people are currently using Resmed's devices. So there's this really strong demand outlook for the business. And Resmed have grown earnings really strongly since they listed, and they've compounded earnings at 15% over the last decade. And there are a few reasons why we like it right now. Firstly, one big focus of Resmed investors over the last 2 years has been the impact of GLP-1s or weight loss drugs on Resmed, as being overweight is highly correlated with sleep apnea. But we're 2 years in, and the data is suggesting that, if anything, GLP-1s seem to be driving people into the sleep apnea funnel, and hence are actually supportive of demand. Because when people are going to the doctor and asking for a GLP-1, sleep apnea is being raised with them, often for the first time. And most people that have sleep apnea don't know they have it.
Yep.
Secondly, there's another demand accelerator emerging, which is the growing consumer focus on health, wellness, and sleep. And the major tech companies globally are investing accordingly. So the latest Samsung Galaxy Watch or Apple Watch, which have user numbers in the hundreds of millions, are now actively marketing that they have FDA-approved sleep apnea testing in their products. And the other major wearables product manufacturers are probably not far behind. So the trend of wearables and focus on sleep, which is in its early stages, has the potential to support demand for years to come. The third factor is, like you mentioned, Resmed's share price has bounced around recently on tariff headlines as it manufactures its products offshore, and the US is its biggest market. But there are two levels of defense that Resmed has here. So firstly, Resmed manufactures its products in Australia and Singapore, which are low tariff jurisdictions, whereas its two major competitors manufacture in China and Thailand, respectively, which are high tariff jurisdictions. So there's a relativity market share argument under that tariff scenario that Resmed could be better off. And secondly, things can move around here with the US government and Trump, but so far the US government I've got to have the caveat in there. So far the US government have reaffirmed to Resmed that they should receive tariff relief because their products serve chronic respiratory conditions, and there's a long-standing exemption for that category. So there are two levels of defense here, and if anything, Resmed appears to be a relative tariff winner. So you've got this very high-quality business with a structurally very strong demand outlook and potential upside from GLP-1s and wearables, but it's still trading at an attractive PE multiple of 23 times, which is lower than lots of mature ASX businesses with much weaker growth prospects.
Right, solid. I love it. Resmed is a buy.
I think I'm going to buy.
And that does us, Will, for this episode of Buy or Sell. Thank you so much for joining me. It's been a lot of fun.
Yeah, it's great to be here.
Where can people find you if they'd like to hear more from you or from the team?
It's probably best to just check out the Auscap website, Auscap AM. Just type that into Google. We've got a monthly newsletter, and we put out pieces every quarter, and we also do regular webinars, so you can join our mailing list there.
All right, awesome. And if you'd like to hear more from me, of course, you can find me chatting to my Economist brother on Comedian versus Economist, with new episodes out every Wednesday. But that's it for us for this edition of Buy or Sell. Until next time, it is bye for now.
Bye, Adam.